Welcome to Trading Nation. I'm Sara Eisen. Let's take a look at a curious divergence in the energy market. Check out crude oil up 11% this year. This as the energy sector is in the red. So will energy stocks catch up to oil? Let's bring in the Trading Nation team to discuss. Craig Johnson is with Piper Jaffray. Chad Morganlander is with Washington Crossing Advisors. So Craig, how does the XLE energy ETF chart look?
Well, the XLE energy chart looks like it's at an area where you're close to support. I just note that the divergence between what we're seeing with crude oil, the XLE, this is a divergence that is clearly going to close. I'll tell you, Sarah, nobody wants to talk about energy stocks at this point in time. They don't want to look at the charts. They don't want to even talk about crude oil. Most places are underweight the energy play. They've been burned by it. They haven't wanted to come back to it yet. But at this point in time, I look at the charts. A lot of the individual companies, they all look very, very washed out. So from my perspective, we're overweight the sector at this point in time. And I think if we're going to get any sort of pullback, shakeout, a deeper pullback and shakeout, I should say, in the broader market, I think energy is probably a space that some of that money is going to rotate into, given how weak the performance has been so far this year, and that divergence in oil prices should actually be a positive ultimately for earnings as you move forward into the second half of this year. So we like it, and we're overweight.
All right, Chad, what about you? You think this can assume a leadership position again?
Well, we're neutral on the sector to underweight in the short run, intermediate run, as well as in the long run. I think what's happening here is that investors are terribly concerned about three factors. One, China growth has actually been one of the critical contributors to demand for oil. Any type of reset there within policy for credit growth is going to have this washback effect on demand for oil. Secondarily, you do have the United States that is actually going to become, in our estimates, over the next 5 years, the largest producer of oil. And they're not directed by OPEC, hence the reason why I think there's a little bit of concern there. And the marginal cost of actually getting oil out of the ground is plummeting, due in part because of technology. And then lastly, the critical thing that investors have to know is that many of these oil companies are levered. And if you do get this rollback of oil prices, then you're going to start to see credit spreads within the high yield market blow out. So we would be much more cautious on this sector overall going forward.
All right, Chad and Craig, thank you for joining us today on that divergence. And thank you for watching Trading Nation. I'm Sara Eisen. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.